What's good, everybody? Welcome back. Somebody in my Discord asked me a question and I forgot to answer it, so I figured it'd be a good idea to make a video on it anyway. But the question was, where do I start? Basically, right? Like, what's my top down from looking at the chart? So let me just break it down as simply as I can. When I sit down at the chair to start my trading day, what's the first thing I do from top to bottom? Okay. Now, everyone has different methods and different ways that they go about it. A lot of people start on, the daily. Check out the daily. Are there any obvious daily gaps that are unfilled? Any gaps that have been left behind that we haven't tapped into in a long time? Things like that, right? Um, I personally like to look at the 4 hour more than the daily. Um, in my opinion, if you look at the daily, you're gonna be like perma bullish, because we're always kind of just moving up. So I like to look at the 4 hour. It kind of spreads things out a little, right? So let me just give you an example. If this is exactly what the chart looks like when I sit down tomorrow morning, what I would do, okay? So I would look for like same thing as on the daily, right? Here's the 4 hour. Is there a bullish gap somewhere that price is bouncing from? Sure, there's one right here. Okay. Then what's another thing? If we're looking for, so basically I look at the top and the bottom of the chart, right? Is there bullish gaps to the left holding price up? Okay. Is there bearish gaps to the left that can hold price down? Okay. So now when I look to the left here on the 4 hour, what do I see? Let me remove this. Here's a 4 hour bearish gap that I could use as a confluence to what? Possibly hold price down. And on the flip side, if we're bullish and price is being held up by a bullish gap, I can use this as a potential target for price to reach for, because why? It's an unfilled gap. Now, find my gaps on the 1 hour, the 4 hour. Basically, I just start from the 4 hour and do the same thing all the way down, right? I look below price, I look above price. Is there something below price that we're bouncing out of to the left? Yeah, cool. Then I'm going to mark it. Is there something that price is, let's say, rejecting from to the left? So for this example, here's a 15-minute, right? So I zoom down to the 15-minute. I see, hey, this 15-minute is currently holding price down. So I'm going to mark that out until we what? Close above. Because if we close above, then that means this gap has been what? Officially disrespected. So then I can confirm my bullish bias to what? The next target, right? Now, as long as this 15-minute gap, 15-minute bearish gap is holding price down, well, then maybe that gives me enough reason to try and look for a short, right? So let's say I zoom down, right? So that's where I start, right? That's how I find my long-term and short-term to mid-term bias, by basically just breaking down each gap above or below down each time frame, right? So if I see a 15-minute gap here holding price down, okay, well, I can expect retrace action, right? To what? Well, the next bullish gap below that we could what? Bounce from. So until we close above this, I'm thinking price is going to do this, right? If we close below all these gaps, then I'm thinking I'm bearish to here. So that is my starting place, right? And then I basically just work my way down each time frame with that same logic. Okay? So 5 minute, okay? Now I can refine this even more. So at first, right, the 15-minute gap, it's this big gap, right? Here's price. But now I zoom into the 5 minute and I can see, oh, hey, actually, this gap seems to be what's really holding price down because we can't close above this. So now I'm refining my targets slash gaps that I'm using for bias little by little by going down each time frame, right? So now I have this 5-minute bearish gap mark to the left. Well, now I can stop and think, okay, are there any good targets below that I could use if there was a short entry? So then I look at that. Yeah, I've got a swing low here that's inside of this gap. That's always a good target. Got this swing low that's inside of this gap. That's always a good target. So yeah, okay. If we did get a short setup, maybe I would be opposed to looking or inclined to look for a short because look, we also have a little bit of a trend line here, right? So then I can start looking for what? Gaps on a lower time frame to look for my entry, right? So higher time frame, bias. Lower time frame, entries. So I'm using my higher time frame gap, this 15-minute gap, this 5-minute gap, to determine my short-term bias, meaning it's holding price down. So if we get now this is not going to be a perfect example, but I'm just going to use it. So now if I zoom in, okay, here's this 2-minute gap, right? Now, if we get some bearish candle that just wrecks this 2-minute gap, plus we have these targets down here, plus we have delivery, plus we have a sweep buy side, now I can say, okay, well, here's all these different confluences I can look at to go short now, right? And the same on the buy side. Same if I was looking to take a long, right? So now I look down here and say, okay, check it out. Here's this gap. We've bounced out of this gap once already. So maybe I draw this gap, extend that out, wait for price to come down. Like if I have a bullish bias and I don't want to look for a short, right? I can use this gap below as something that we could bounce out of. So it's basically the same on every time frame, right? Like you just use these gaps to do short-term, long-term bias. And then obviously we all know the IFVG model, the entry model, is when these gaps get inversed. So, yeah, that's pretty much it. Targets, and then obviously you can start adding things like premium and discount. Did we have an aggressive move down? Okay, cool. Well, if I want to continue to look for a short, maybe I wait until we're back in premium. Did we have a big move up? Here, okay, well, we had this move up. Maybe I wait until we're tapped down into discount before I look for a long. But that's, that's a little different. But yeah, that's basically my top down, man, is I use gaps like this and just break it down smaller and smaller to determine the most probable direction market wants to go. Then I zoom in or out and find targets that are good liquidity points. And then I use the small gaps on the lower time frames for entries to get in to target higher time frame gaps or swing highs and lows. So yeah, sorry if that didn't make any freaking sense at all, but that's pretty much how I go about it. Peace.